Hey, Luke. How's it going?
Going all right. Welcome, everyone, to the Root of All Evil podcast. We are a couple guys, finance, econ background, interested in some stuff, do some research, and wanted to share it with you, generally along those topics. And today, what are we talking about?
FOMC meeting.
Yeah,
This
the
week,
big thing
the
this
Fed
week.
just had their December meeting. Big news, lots of stuff going on. Wanted to dig in a little bit.
All right, so what they decide?
Well, they cut rates again. So, not a whole lot of fireworks there, but across other asset classes, stocks have been selling off. Treasury yields have been going up. Those have been selling off. People feeling a little nervous now about all this. But why is that? That's what we'll get into on this episode of the Root of All Evil
Yeah,
podcast.
yeah, and just kind of for the listeners, just for some background, this is definitely more directly in Joe's wheelhouse. Just kind of for his background, he
Oh,
follows this very closely. I do not. So I do and I don't, but not nearly as much as he does. I am on the banking side, working treasury. I follow rates. But as to why and stuff, that's hopefully he can shed some light on. But I did see, I was reading the Wall Street Journal today, and I think, Joe's kind of got his finger on it. Just the opinion column just said the Fed admits an inflation mistake. That was the top, that was the head of it. And I'll just start off reading it. Just like the first sentence was, "Well, that was ugly." We mean the big sell-off in stocks and bonds Wednesday following the FOMC's decision to cut its target interest rate by another 25 basis points. So, like, Joe, what is?
so what happened? More or less, it comes down to inflation. Just like everything over the past couple of years, everything's all about inflation. It started to get out of the topic for a little bit recently, just given that inflation had come down. The Fed was feeling very confident about that they did their job, they brought it down, all these different things. But this time, they kind of, in a bunch of different ways, they released all these projections. There's summary of economic projections that alludes to this. Powell in the press conference, he was asked a bunch of times about this, and he kind of alluded to this with the takeaway that inflation might be a little higher than they originally thought. So, as compared to earlier in the year, even just the past meeting in December, November, just a month and a half ago, they were very confident that inflation was going to be back to 2%. Like I think the number is 2.1% by the end of next year is their projections, for whatever that's worth, but that's what they thought. And this time they bumped it back up. So they're like, they don't see inflation coming down to 2% until, for like a few years from now. So they see it kind of bouncing around where it's at now, kind of in the mid to high twos. And it doesn't sound so bad, but, when you're talking about nationwide, the amount of inflation going on, people can get very upset at 0.1, 0.2% differences.
So, why did they decide to cut it all? I mean, if all of a sudden now they sort of changed their view on where inflation is and will be, why cut?
So everything they do is in pursuit of this dual mandate that they have. So that's the pursuit of stable prices and maximum employment. So obviously, over the past couple of years, it was all about inflation. The more you try to tamp down inflation, the greater the risks are that you're going to damage the labor market. And that's more or less what we saw happen, or rather start to happen. Inflation came down around the same time. Unemployment started to very slowly go up. Basically speaking, that's pretty much what prompted them to begin cutting. And now what's prompted them to continue on this one is it is a little bit of a head scratcher. Exactly. Like they think inflation is going to be a little bit higher. So why cut it all? And the answer is that, or, at least what Powell was saying, I think this is where their head's at generally. The other thing that they're very focused on is this thing called the neutral inflation rates. They'll call it like R star or in kind of the jargon, but this neutral rate of interest. And they define it as the interest rate with which economic activity is neither stimulated nor tamped down upon. And it's a theoretical concept. There's no way of measuring it, but people have a rough idea of what it is. And so this is a long way of saying that they cut because they thought that the current rate is still above the neutral rate of interest, meaning that they think that interest rates currently are restrictive to economic activity. So at a time when unemployment is slowly starting to increase, they're a little nervous about keeping rates too high for the labor market to become more damaged more quickly. And their worst case that they really want to avoid is having it spiral into a recession where unemployment suddenly spikes up very quickly. And then there's, large sell-offs, financial issues, all kinds of different things like that. So they started cutting. They think maybe we don't need to cut as much, but we're still going to cut because we want to get a little more neutral. We don't want to be quite as restrictive anymore.
That makes sense. But what they're impacting, or what you're describing now in inflation, and then as well as unemployment, is sort of stuff that happens maybe in like the real economy. Why did people start selling their stocks and bonds suddenly?
It's all about outlook. Okay. So prior to this this meeting, people had the idea that previously at the Fed thought that they were going to cut 3 times in 2025. Their projection, updated one this time, says now it's only going to be 2 times, and it's all about outlook like that. So the other thing, it's a combination of that and asset pricing has run up very quickly in the basically throughout the year in the U.S. here. So stocks, mainly risk assets, we're saying. So stocks, and then the other big one that people are talking about again now, especially after the election, is Bitcoin and cryptocurrency and things like that. And we're getting to the point where some of these silly crypto coins as well are rapidly increasing in value when there really is no value. So that's a proxy of animal spirits are high. So anything that's going to kind of go against that narrative, everyone's going to get spooked really quickly and start selling off. And that's effectively what happened yesterday.
Yeah. So I guess, so to summarize, or at least my understanding, let me know if this is wrong. People were going into this meeting sort of expecting a certain outlook being maybe more rosy. They were expecting more cuts, which usually signals that the Fed is, well, I don't know, actually. If they're going into it and they're expecting a lot of cuts, then that wouldn't necessarily mean that there was like a positive outlook. I think cuts are often associated with, maybe a concern or wanting to stimulate the market. And now the fact that they're saying, we don't want to push on the gas quite so hard. Hold on. I think we should cut this out for a second. It's like, so I understand. Let me try that again.
You're actually touching on the exact point.
This is embarrassing.
No. You're touching on the exact thing in that we're at this weird time right now where it's not super clear. One of the things people say, and basically where we're at right now, is that good news is bad news, and bad news is good news.
I guess the point, or like the main takeaway, is just what everyone thought the Fed was going to do, turned out to be something slightly different, and then the market is going to suddenly change to that new outlook or Fed expectation as fast as possible in order to kind of capture whatever potential money making chance there is.
So people in the institutional market, there's so obviously there's many different kinds of investors. So you can have people that are kind of like more traditional asset managers, where you're talking about like pension funds and 401ks and all that kind of stuff, and they all have some standard allocation into these different asset classes, and day to day they don't really change so much. On the other side, on the other extreme, you have like hedge funds and these like high frequency trading firms that are just trading all the time, just trying to pick up on little mini price dislocations that they see out there. They're not they're trading in a way that's much more sophisticated. So a lot of times, whenever things like this come out, at that, like within seconds or less than seconds, these things will typically start to move. So every Fed meeting, whenever it ends on, they're always on a Tuesday, Wednesday, they end on a Wednesday afternoon at 2 p.m. sharp. They release the press release, and it basically says what they did. As soon as that comes out, they'll have these algorithms in place that are looking for this, waiting for that second that it comes out. And if it's good or bad news, and that's, measured by some model they have, ChatGPT and stuff like that makes it super easy nowadays. They will do things very quickly, within seconds, can start moving large amounts. And so a lot of times when people see that, those that aren't driving it, you're kind of like, well, why is this going on? Maybe I should sell too. And then you have this other level of kind of a self-reinforcing process there. And, then you could also have everyday people like, retail investors that are just looking at their phone on Robinhood or, what have you, that they see things selling, they might get spooked and they'll start selling. And then it just goes on and on and on. And so this one was actually pretty interesting, though, because I think the statistic was something like this. It was the worst stock sell-off day since like 2001, or the worst Fed day, the worst sell-off on a Fed announcement date, I think, since 2001. So that covers a lot of ground. Yeah, it's like that covers COVID, so that covers all the inflationary era,
wrong, so to speak.
I mean, I think it's honestly like, talking about the stock market, I think it's more a function of like valuations and stuff like that. The prices were already super, super high. People were
okay. So you just think they're just kind of spooky right now. So they know that they're sitting at a high right now. They know that there's
super high right now.
Probably going to go down. So the fact of any
go up
news,
every single day, without end.
They're waiting for a crash, and they thought this might be it, and they just cashed in the high value stock that they had.
Yeah, so
it was a spook. Okay,
yeah,
interesting.
Pretty much. So it's like, does this affect like the underlying outlook? I don't think so at all. And kind of the point was, one of the main reasons why they think there could be more inflation over the coming year, a lot of it goes back to just the economy itself. It's continually stronger than expected for basically 2 years now. Everyone's, recession's coming, they raise rates so high, recession's imminent. This always happens. It's going to happen. And it's just never happened. And all the data that comes in is just very strong still. Labor market is starting to kind of get a little bit weaker, but we're in this weird spot now where the economy is doing really well. So that's bad news because the Fed might not cut as much, but the economy's doing well. So that's what I mean. Like the underlying isn't really changing, but yeah, the day-to-day trading, yeah, there's going to be some little hiccups here and there.
Yeah, no. This is what I was talking about. The article, the Fed admits an inflation mistake, and that was ugly. And what they're referring to is the big sell-off. And it sounds like what you're saying is maybe it's not so much the Fed's fault per se, but it's a combination of that. We're already kind of at this really high water mark in terms of stock prices, and people in the industry feel like it's more likely to go down than up. So any little jiggle is going to make people run, cash in what they can.
Yeah, that's more or less my view.
That's your view?
I think that's, I don't know, it seems clear to me just based off economic data and all that sort of thing. But this kind of article, that opinion obviously is super common. That's why we have the sell-off. The other thing, obviously, in addition to just creating the policy, the Fed is also in charge of communicating that policy. And just as important, very important, maybe not just as important, is doing it in such a way that it doesn't spook people. So a lot of times, financial moves, like moves within financial markets, can be self-reinforcing. If people panic too much, it can cause other people
Yeah.
to panic. And then when things aren't really all that bad. So whenever the Fed does kind of change their view a little bit, they have to do so very delicately. And I think the criticism in this piece, and like a lot of others saying similar things, they weren't, maybe they were a little too blunt in how they can't.
Oh, too blunt. You don't think it was a matter of, just kind of listening earlier, you don't think it was a matter of getting kind of mixed signals? So in the one sense, they would be like, we're cutting,
signals.
but then sort of if you
It's
actually
mixed
look into
signals
the
in
report,
terms of inflation outlook. And one of the other specific things that during the press conference that Powell was criticized quite a bit about is tariff policy.
Ooh, okay.
So the last FOMC meeting was the day after the election. So you can imagine there a lot of questions were related to tariffs, related to the election, all these different things. A lot of the questions at that point were like, if Trump asks you to step down, would you, or can he fire you, or can he fire anyone on the FOMC committee, et cetera, et cetera. And he was giving like one word answers, just like no, not permitted by law. He just like was so careful about what he's didn't want to say things to spook people, and he didn't want to come off as haughty or something like that to Trump.
Birdies.
Exactly.
He didn't just start, no mic drop moments.
Pretty much.
Holding the mic real tight.
Related to that, same thing. People were like, all right, well, Trump got elected. So what about tariff? Or so what about inflation? He's, as we talked about, he's been, sending out all those posts about all these new tariffs in China, Canada, Mexico.
Yeah.
It's going to be inflationary, whatever. So everyone was really concerned about that last month. And his messaging at that time was, we don't make any assumptions about policy.
Yeah.
We don't do it. We don't make assumptions. We respond when we hear about it. He said, we're going to wait until the administration comes in. We'll respond to it at that time. Right now, we just have no idea what's going to happen because nothing has happened yet. And that's a fair enough point, generally speaking. People weren't upset about that. There was no major market reaction. The past meeting, they cut by the same amount.
My feedback was maybe that's kind of part of the problem. The Fed is so reactionary. They're reactive. They're not proactive. Is that like it's a criticism of them.
Yeah.
I guess so. It would be, you can imagine like after that government spending bill that came out, they were like, oh, this is an inflationary pressure. This is a significant inflationary pressure. Maybe we should start, jacking up rates now. That would have been that would be gutsy call though, I guess, in terms of central bank.
That
central
would be
bankers,
too
that would have been like before they started seeing any sort of signs of inflation, they started jacking up rates to slow the economy.
That would really
people. They would have been a legend if I don't know. So that's the other thing about kind of central bankers is like you never hear about them unless they do something bad. So like it would be one of those cases where
it's a thankless job.
It's a it's a thankless job. You get attention on you when something goes wrong. If they're doing your job perfectly right, no one even knows you're there.
Inflation.
So that's true. If they started calling it transitory and got it wrong, that's egg on the face. But imagine
that's exactly what happened in 2021.
You would be a legend among central bankers, unfortunately, and central bankers only, which is not a very large number of people. If you were able to predict like the inflation and you jacked up rates and you kept it at 2% or whatever it was, no one would notice. But that would have been such a gutsy call.
Yeah.
So I think it's kind of interesting if you actually look into what the incentives are here. Mm-hmm. You play it super safe. Be reactionary.
Mm-hmm.
Because you absolutely cannot jack up rates, sink it into a recession, and then
right.
So that's interesting.
Yeah, it's a very different balancing act, or very delicate balancing act. And just on tariffs, last thing, one of the other things that Powell got criticized heavily about was, like I was saying, the last meeting he was very, very straightforward. It's like, we don't make assumptions on policy till they come out. This time, he said something along the lines of, some of the committee members have begun to incorporate initial inflation tariff effects or something like that. So he basically said the exact opposite this time. So there was also a degree of, what do you talk, like, do you or don't you make assumptions about it? So that's another reason that just, all else equal, added to the uncertainty, spooked people a little bit more.
Yeah.
It seems like a subtle point, but just, and like, it was just one offhand comment.
You don't know how they're thinking about it. They're not being forthright, forthcoming.
I mean, the thing is, they're very forthcoming. They're very forthright about the methodology of what they show and all these things. I think the problem is with how people interpret it. So what they do is every meeting, basically what these people's jobs are, they're the regional central bank presidents and, some of the just the committee members in DC.
Yeah. So I guess, just to make sure, because I don't know if everyone listening is kind of familiar with the structure of the Federal Reserve or the central bank. He has a central bank, and Chairman Powell sits in Washington, but there are 12 regional banks. There's a New York one, which is significant. They're the ones that actually kind of run the market operations. But then there are a total of 12.
Money printer goes burr.
There are a total of 12 of the banks that are scattered around, and each of those have a president, and they all come together. And some of them are permanent members of the FOMC that decide where rates go. So like New York, for instance, that's always there. But then other ones, the smaller regions, sort of get
they kind of rotate back and forth.
They rotate out
every year. Yeah.
Sorry. So.
Oh yeah.
So you're saying the 12 of them.
It's a lot about people interpreting, or maybe over-interpreting some of the numbers that they put out there. So what they do is, whenever they come together and meet, and then ultimately talk about what they should do with policy, then come out and make some decision. In order to make that decision, they've got these armies of economists, PhDs that are just, everyone's trying to be proactive and, kind of spot things before they happen and understand the world the best they can and all these different things. And with the field as broad as economics, you can have very different views kind of ongoing. So every bank president, they've got their own army of economists. They've all got different things in their region that they specialize in. They've all got these different views. So the president takes everything together. They have to come up with their own views. So they take all the information that they can. They think about what it means to them. And then during the meeting itself, they survey all of the committee members. So those on the board of governors, those that are not, regional bank presidents, that are permanently on the board there, as well as the bank presidents and Powell. They write down what they think are their most likely assumptions for all these different indicators. So, for example, one of the questions is, where do you think unemployment will be at the end of this year, at the end of next year, the following year, and then a more general long term? So that's a really broad question. Where's unemployment going to be in a year? Where's unemployment going to be at the end of 2027?
Yeah, no one knows.
I could say something. I don't know how much it really means, though.
Right.
So what they do is they ask these questions, all these different things, and then they take all the responses and put them together, and then they have this median number, more or less. So one of the other questions they ask is, where do you think rates will be at the end of each year? And that's saying, how much are we going to cut, at this point, pretty much. And everyone has a different, or not everyone has a different answer, but, there's some distribution of answers, and then they take the median point. And this time, the median point just so happened to be 2 rate cuts next year. And that's now what people think is going to happen. That's what they say, the Fed's going to do this now. It's like, well, technically there was some that thought it's going to be 4 cuts, some that thought it's going to be 3 cuts, others with, in such a way that 2 was the median. There's some that thought there's going to be 1 cut. I'm not sure if there's some that thought that there was going to be 0. But so I guess what I'm saying is, number one, these are all super broad questions that they ask them. Huge room for error. And in fact, they're almost always wrong. You can't predict the economy, more or less. I mean, you try, but and then
what good are economists, really? I mean, I studied economics, and it's just like, it's an impossible.
No, I mean, me too. It's you want to be able to predict things, but I think the best you can do is just understand things.
Yeah, even that's sort of a. The thing is, like I
You can
think,
understand things maybe like once they're like 3 decades in the past.
yeah, and all that really is just people arriving at a consensus as to like what the truth is. Even to
Yeah,
say
and
that they really
also,
understood it. I think the measure of someone's understanding is your ability to predict something. Not even understanding, but it's a combination of understanding and knowledge. You know, what you can measure. Like if you can't measure it, for instance. So they kind of compare, or I sort of compare it in my mind, physics and economics. And like in physics, you're able to predict with incredible accuracy where a planet is going to be in like 100 years.
right.
But that's a combination both of us being able to accurately measure something, as
Mm-hmm.
well as us having the proper tools in physics to figure out, with accuracy, able to
Right.
predict something in the future. And just with economics and the economy, it's both a combination of, I don't want to say poor measurements, but it's so vastly complicated that
Right.
you just can't do it.
Like
Um,
in comparison, like the physics question almost seems trivial because there's like one driving force, more or less, to saying where a planet's going to be. Like
right. Yeah. I
gravity, the
mean,
theory of
like,
gravity,
look,
right?
I don't
It's
want
like
to.
if you understand that, you can say a lot. But in the economy, by definition, talking about U.S. economy, it's over 300 million people getting up and going to work every day.
Yeah, making all these little decisions about kind of their life and what they want to
Exactly.
do, and it's
The unemployment rate is
ungodly.
the net effect of all these little decisions from millions of people every day, and
Yeah,
it shakes out somewhere. But how well can you
yeah. So I
even
think,
hope to precisely kind of pin that down?
mhm. So yeah, you get a 300. What has that joke go? You get 300 economists in a room, and you have 500 theories.
Sounds about right.
I just don't know. We just don't know. So
Yeah.
anyway, let me get your take on something else that I saw at the Wall Street Journal. Um,
What do
does
they
the
got?
Fed even know what it's trying to do? Yeah. So these rate cuts are hard to explain alongside the projections officials released Wednesday. So I think you kind of touched upon this.
Right. Why are
So
they cutting rates if
so
they
it
think
says, like,
inflation is going to be higher?
we might as well confront it head on. What the Federal Reserve did this week doesn't make any sense.
Fighting words here, coming
So
on strong.
yeah, I mean, there's grabbing some clicks. The FOMC on Wednesday cut the target range, blah blah blah, by a quarter percentage point. So now we're in this range. Third consecutive rate reduction. Um, the first in September was a quote jumbo half point cut. The central bank's policy rate now has fallen a full percentage point from its post pandemic peak. This is remarkably dovish. So this always kind of got to. So dovish just means that they're not cutting enough. Does Hawks want to cut? Doves want it higher, or is it always in context?
I mean, generally speaking, Dove and Hawk is like Dove is like easier policy,
Easier.
and
So
Hawk
they
is like
want.
more
When you say
restrictive
easier
policy,
policy, you mean like they want rates lower.
less restrictive. Yeah, like
Yeah.
promoting or economic activity, that kind of thing. Like it's
So
the, like hawkish is used in the same way in like terms of war and stuff like that. If someone is a war or war hawk, I think for lack of a better term, but yeah, if someone's very aggressive, they're
so
very hawkish.
got it. So like in this case, again, aggressive towards inflation. They're in the
Right,
sense of fighting inflation.
right.
Okay. Not in the sense of like fighting unemployment or like stimulating the economy. They're not aggressive
Right.
in terms of
So
stimulating the economy. They're
yeah.
aggressive in
So
terms of fighting. They're hawkish in terms
uh-huh.
of fighting inflation. So
In this
dovish,
context, yeah, you would think you would if you think inflation's going to be higher, you'd think the prudent thing to do would to take a hawkish perspective, but they
right,
seemingly did the opposite.
right. So they're remarkably dovish. So they're saying, oh, we're surprised that they cut. Now they argue inflation remains well above the 2% target.
So just like by the way, like a little bit of context, the
Yeah,
latest inflation number, which came out I think just a week ago for November, 2.7%.
Okay.
It
That
peaked at
sounds
9 point something percent.
reasonable. I mean, I don't know.
Yeah, it's not
2 to 3.
terrible.
Like, what do you want?
Is it well above Fed's? Yeah, I mean, that's the thing. It's if they say 2%, if it's not at 2%, then people are gonna throw their arms up in the air.
Right. I mean, yeah, fair enough. Actually, that's a good point. I disagree that it's well above the 2% target, 2.7.
Yeah, I
Nine
mean, if you
percent. You were hitting 9% or whatever. That's well above it.
right,
4% well above it. But shit,
hmm
it's still got a two handle on it.
yeah, it's like you're not that far
Also,
off. Yeah, you're
yeah.
above, but
Also on Wednesday, central bank officials conceded their quarterly economic projections that inflation this year has been more stubborn than they had foreseen as recently as September. So that's what you were saying earlier.
right. I've actually
They're
got the chart on this that shows that. I don't know how deep we want to go into it here.
then it says cutting rates, despite all this, is an even bigger head scratcher than it first appears. Cast your memory back to December 2023, another FOMC meeting. Instead of quarterly projections, Fed official floated the possibility of rate cuts totaling 3/4 of a percentage point for this year, while assuming headline and core inflation both would be 2.4% by now. And we would be on track to reach 2% by 2026. I don't know, nothing too exciting there.
Yeah, that's so they thought it was 2.4% by the end,
By
or
now.
by the end of this
And to
year.
be fair,
Yes.
I mean, to give the Fed some credit, I mean, pretty close.
Yeah.
I
I mean,
mean, give me,
it's
you got to give some credit where it's due. I mean, they predicted this. We
yeah.
were
No,
just
technically
talking about
that
how,
that number is PCE. The one that I quoted is CPI. Not to go. So they're slightly different. But what was PCE? I don't think November's even out yet. October 2024, 2.3%.
oh, so even closer than we thought.
Yeah,
Give them some credit.
it's not bad.
Come on.
Yeah. I
This
mean,
is
but
kind
I
of
guess
another,
in a way, if they were that close, now they think next year's going to be higher. Maybe people believe it more, and so that's troubling.
heaven forbid. Yeah.
But if you're quibbling over 0.23%, you're going to say the Fed does no idea what they're doing.
Yeah. But Joe, this guy's got to pump out like 3 articles a day. All right. Or whatever it is. Sometimes you got to make a story out of very little here.
Yeah,
Honestly, so far we are all of like 5 paragraphs in here, and that's sort of my takeaway. This is a
pretty much.
big load of really nothing. We're talking about a couple. Yes, there were a couple bases. There were a couple 20, 30 basis points off.
But yeah, so I mean, long-term perspective probably doesn't matter all that much. But if you're looking at day-to-day prices, the Dow is down so many points. Like, yeah, you gotta
Yeah.
write about it and talk about how bad the Fed is.
Yeah. Okay. To resolve this incongruence, the Fed on Wednesday attempted to transform its dovish policy action into a hawkish cut via flapping of the institutional jawbone. Ouch.
Wow, they're getting little,
Just getting a
little
couple,
bit
yeah,
poetic here,
a little
almost
punchy. Yeah. This is
they really are
forward
looking
guidance.
for things. Yeah.
Charting about what the Fed will do in the future to manipulate the market today. This is forward guidance. The idea is that so forward guidance, by talking to investors, the Fed can loosen or tighten financial conditions independent of any concrete action by the FOMC takes. So, I mean, correct me if I'm wrong, but sort of the way I take about forward guidance is like, by example, if the Fed said, hey, 6 months from now, we're going to cut a bunch of rates, the market will move.
Yeah,
right.
Exactly.
It
like,
will
especially
move.
if they,
so they didn't do anything, but they still were able to move interest rates.
Just like tariffs.
Forward guidance. Here, the goal was to tighten, or at least to loosen a bit less than the rate cut itself might suggest.
It's getting very deep into small details, and once you're at that level, you can present a perspective kind of any way you really want to. And seems like that's what's going on here. But to their credit, again, they're writing day to day. Like you said, they got to get 3 out a day, and they're kind of guided by what the markets are doing on that day.
Let's look at some of the comments.
Oh, this should be good.
Yeah, let's respond to these comments. Well, this one, Wall Street Journal should focus more on what the Fed does with its balance sheet. That's kind of interesting, actually. I could kind of get behind that.
Yeah, I would say though
that I don't think a lot of people really understand that, and there's so much focus around interest rates and stuff, but then there's this whole concept of QE, and just you can actually just see the monetary, quantitative easing, or QT, quantitative tightening, and what happens on the balance sheet is what everyone feels in terms of general market liquidity. People don't talk about that. People don't. I got Tony P. Yeah.
Oh, he gets a like. Call him up after this.
Yeah. Does Fed even know what it's trying to do based on past performance? It is doubtful. Got him. I mean, there's so much, especially talk sort of with the incoming administration now. If end the Fed, or Ron Paul now is definitely, an end the Fed kind of guy. Maybe we should just come out and say, so just to be sure, both of us worked at the Fed, and our views are not, those of the Federal Reserve. These, our views do not represent necessarily those of the Federal Reserve. These are our
we don't work there.
Views. We no longer work there. I was a bank regulator. Joe worked in markets. So full disclosure. But in terms of our opinion of the Fed, it's positive. And I think most people who have studied economics and finance regard it as a very august institution. Generally like it. I mean, really what it's out there to do is something that's deeply, underappreciated. And that is essentially manage the value of the future value of the dollar. And, this could be like its own episode, but just to kind of show you where our biases are as we go through this. So it's about time that bond prices are above the federal funds rate. So the Fed needs to lower rates another full point by the end of next year, as the markets were expecting. I mean, okay, if they don't continue to lower rates, the economy will go into a recession. Why is the Wall Street Journal against growth? Okay. I mean, there's a lot to respond with there.
Right. I mean, that's pretty
what's your take with the bond prices are above the Fed funds rate? First off, a price is not, they don't mean price. They mean yield.
That's right. Yeah. So that's the idea of this yield curve concept. And it's saying that all else equal, it's better to have money today than in the future. So if I lend you money for 10 years, I should have to pay you more for that.
Yeah. I mean, they're just,
for a while now.
I mean, isn't it, they just mean that it's a no longer inverted yield curve? Is that exactly what he's trying to say? Yeah.
Yeah. So it's there's nothing inherently wrong with an inverted yield curve, but just after, many decades, it's one of the most reliable indicators of a recession is coming. And that's one of the big reasons why over the past couple of years, people have been continuously saying we're going to have a recession, because it inverted in mid 2022, I think. And just now, 2 months ago, it has uninverted without a recession happening. So looks like a pretty good outcome so far.
Yeah. Why is the Wall Street Journal against growth? It's it's not. I think this guy's just trying to write an article. And I don't think he represents the views of the entire editorial board. It's just one guy, right?
Oh, yeah.
Yeah, it's just one dude. Isn't it time we supported growth? Yeah. As though we didn't do that after rates went to zero.
Yeah, for over a decade.
instead of trying to thwart it, they're trying to beat inflation. Thanks for clicking on the link. Talk to you guys later.
See you next time.
Bye. Yeah, see you next time on the Root of All Evil podcast.
See you there.